Hey everybody, welcome to your weekend review for the mortgage and bond market for the week of August 8th, 2022. And oh, what a week it was. Monday opened up positive for bonds being up 14 basis points real early, with the 7-year being down 7 ticks. Right away when I woke up, stocks were up 38 points, but things changed radically throughout the day. MBS ended up 31 basis points on the positive side by the end of the day. The Treasury was up 9 basis points, and the S&P gave back all of that room from earlier in the day. Over the weekend, we got quite a bit of stuff. The market is processing that jobs report from Friday. The September meeting is now calling for a 2/3 probability of a 75 basis point rate hike by the Fed funds rate and about a third probability of 50 basis points. The December futures contracts are centering around a Fed funds range of 3.5 to 3.75, which is up 25 basis points versus last Thursday. Over the weekend, we also got some reports from former Treasury Secretary Larry Summers, some real hawkish comments basically saying that nothing in any of the reports indicate that the economy is not overheating and is not yet under control, not even close to it. He also pointed out the core inflation is running about 5%, which is higher than it was when Nixon put on wage and price controls in the 70s. Meanwhile, Atlanta Fed's GDP Now Index predicts the Q3 GDP will come in at 1.4%, though this was before the jobs report. While the 1.4 is still positive, it's by no means strong, although a positive number is gains at this point. The market is still digesting that report. Like we said, there is a weird anomaly within that report where the two different sides of the report are showing conflicting information. The jobs report from Friday is broken up into two parts, a household and a business survey. The last couple of months, they painted very different pictures, being like over 100,000 jobs different from each other. Apparently, about half of the job gains reported on Friday were actually part-time second and third jobs. So it's kind of interesting to see how that's going to bear out for the overall economy, because that's what really matters. This week will be highlighted by CPI inflation numbers on Wednesday and a 10-year auction. MBS are back into a new range, so we're back up here above that 25 and 50-day moving average. We have a Fibonacci line at 101.219 that it bumped into before retreating today, and then another line coming down at the 200-day moving average. So if we can break through that moving average, that 200-day moving average, we have some room to run up to the other line at 102.214, which would be a pretty big gain. We also got news that Rhythm Financial, which is a recent name change for New Res, reported that origination volume was down 29% to $19.1 billion on the quarter, which is down 19% from a year ago. The fact that doesn't include Caliber, gain on sale margins increased by 1.95%. We also got news that the CFPB is fining U.S. Bank $37.5 million for using consumer data to open fake accounts. Taking a page out of the Wells Fargo playbook there, apparently. Ironically, both I think were originally out of Minnesota, if you consider that Wells Fargo is really Northwest, but that's a pretty big chunk of cash. Tuesday turned into a pretty volatile day. Bonds were exceptionally flat in Asian market hours, then followed up when the EU opened up and the bonds went down. MBS were down 15 basis points early. Stocks were down 19.75 points. Before the news came in, lots of news on the day. We ended up being down 30 basis points on the MBS 4.5, down 52 basis points on the 5%, and down 41 basis points on the 4%. Got some good news for the Fed. Inflationary expectations fell in July as declining gas prices improved sentiment. Long-term expectations fell from 6.8% to 6.2%. Bad news, though, is productivity nosedive, declined 4.6% in the second quarter. Output fell 2.1%. Hours worked increased 2.6%. Unit costs rose by a whopping 10.8%, which was driven by a 5.7% increase in compensation. Rising productivity is a major factor in controlling inflation, so productivity was lousy in the 1970s and usually corresponds with a, you guessed it, recession. Small business optimism rose in July. The Treasury sold $42 billion worth of 3-year notes to good demand and strong interest. We have moved into a new range, being at 100.89. It is bordered by a ceiling of 101.219 as a ceiling, and then a strong floor of converging lines with a Fibonacci at that 100.603, as well as the 25-day and the 50-day moving average all converging into a pretty big floor. Fannie Mae also said it's going to start buying lender-funded down payment assistance subject to conditions. They're very specific conditions, but it's a start. Yield curve continues to invert. The 10-year to 2-year spread is now 47 basis points. So the 2-year is actually yielding 47 more basis points than the 10-year, which is part of the reason why you're not seeing great 5-year, 7-year, 10-year ARM pricing. The Chinese real estate bubble continues to burst. The government is going to protect homeowners first and investors second. Very interesting news piece about troubled developer Evergrande, which is the largest real estate developer in the world. Its bonds are now trading at 7 cents on the dollar. As the real estate bubble continues to burst, demand is going to public, which means a trade deficit with China is about to blow out. Great information from Brent Niatre. Check him out. Lots of great news every day. Observers were a bit shook after UWM, United Wholesale Mortgage, reported second quarter profit was up 55%, which is very unique compared to its peers. Origination volume for the quarter was $29.9 billion, which included $22.5 billion worth of purchase volume. Overall, originations are down 23% from the first quarter, but profits are up. Very, very unique. It was also announced that Loan Depot is getting out of the wholesale business. Volumes were down 26% quarter over quarter, 54% year over year. Then we had a positive day on Wednesday. Bond market was well into positive territory, being up 42 basis points on the open. CPI data came out, seemed to demonstrate a slowing of inflation. CPI year over year came in at 8.5% on expectations of 8.7. The core CPI, which takes out food and energy, came in at 5.9% on expectations of 6.1. Real average hourly earnings were down 3%, but that hasn't been positive since March of 2021. The knee-jerk rally had the bonds up. We ended up being up 33 basis points on the day, though it was a little bumpy on the way home there. We saw a decrease in energy, used cars, and apparel. Overall, this is good news for the Fed, especially the decrease in month-over-month rate. One data point doesn't mean everything. However, it does give the Fed some comfort that they are on the right track. The wider than expected decrease in quarter productivity, 4.6%, coupled with larger expected increase in unit labor costs, 10.8%, decrease in the non-farm business sector labor productivity from the same quarter a year ago. Talked about this before. Low productivity corresponds to a recession. Market had a 76% chance of a 0.75 point rate hike yesterday. That's down to 40%. Although we do get another CPI and job report before the next meeting. Being in at 101.22 on the 4.5 MBS puts us right in this new range. We have a ceiling of a convergence of factors with a Fibonacci at 101.210, which we closed just above, but we're below that line of the 100-day moving average at a 101.348, and that super strong triple floor. So we'll have to see what happens as the week goes on. Thursday was a pretty wild day in the bond market. Pretty good opening all the way across for bonds and stocks, with MBS being up 17 basis points early, S&P up 30.5 early on in the morning, but everything kind of went haywire as the day went on. I mean, we were up as much as 20 basis points at one point, and then everything turned back around, down 14 basis points, got an alert to lock, down 11 basis points, and ended up being down 27 basis points on the day. Lots of news came in during the day. Initial jobless claims showed 262,000 claims, which was close to expectations at 264,000. This is above the last print at 248,000. Claims are now near the lowest level since November. Continuing claims rose just a bit to 1.43 million. Fed continues to point at a robust job market as signs that the economy, despite consecutive quarters GDP, are not in a recession. The producer price index declined 0.5 in July when we expected an increase of 0.1. Yes, it actually declined. So that's a rare stat showing that inflation is starting to decline. The decrease was driven by lower energy prices. Final demand fell 1.8%, 80% of which was attributed to falling gasoline prices. Final demand, excluding food and energy, rose 0.2% when it was expected to be 0.4%. Still at 7.6% year over year, which is pretty high, but they're below the street expectations. You would have thought this would help the bond market, but it actually hit things pretty heavy. Between the CPI yesterday and PPI today, we are finally getting some good news on inflation. This is mainly driven by fallen energy prices. Starting to get a shift in sentiment towards a 0.5 increase by the Fed funds rate coming in the next meeting. The odds are that it's going to be 0.5 in terms of betting and what the market is pricing in. Real estate investment trust and non-QM lender Angel Oak Mortgage lost $52.1 million in the second quarter, bringing its net losses to the year to $95.6 million. The REIT is managed by Angel Oak Capital Advisors, which is actually their lending operations. The SEC also fined Angel Oak Capital Advisors and its portfolio manager a total of $1.75 million and $75,000 respectively for misleading investors by actually making payments for borrowers on its fix and flip loan securitization. HomePoint Capital, parent company of the wholesale lender HomePoint, took a loss in the second quarter of 2022 after reducing costs and selling mortgage services right. The company reported reduced volume and lower margins caused by surging rate and aggressive pricing from rivals like Quicken and United Wholesale Mortgage. On Friday, we had a quiet open for bonds being up 2 basis points, but it got better as the day went on, being a total up 19 basis points on the day. The 10-year dropped 5 basis points. U.S. equity futures rose as investors assessed whether signs of cooling inflation will enable the Federal Reserve to pivot to less aggressive interest rate increases. Treasury yields have dropped. The Alibaba Group, which is more or less akin to an Amazon in China, led pre-market decline as U.S. listed Chinese stocks after some of the nation's largest state-owned companies announced plans to delist from American exchanges. Traders have pared back bets on Fed fund rate hike after the news of this week. Like we said, a lot of the odds are that it's going to be a 0.5 increase on the next move by the Fed. Record number of homeowners are looking to relocate to cheaper locations. According to Redfin, 33.7% of homeowners want to move somewhere new compared to 26% pre-pandemic. We also got consumer sentiment today, which came in at 55.1 versus a 52.5 forecast. So that's a pretty big increase. Expectations were 54.9 versus an expectation of 48. And our inflation outlook went down a little bit. So people are seeing and feeling like inflation has maxed out. Hopefully it will come down fast because the number is still high. So the MBS, like we said, ended up at 101.06, which was up 19 basis points on the day. We have a very, very tight converging pattern here. So next week we're going to have to see how this plays out because we have 3 different floors, being the Fibonacci at 100.603, the 25-day and the 50-day moving average as a floor. And we have another Fibonacci line at 101.2, which is converging with the 200-day moving average. So it looks like probably next week we're going to pick a range and see how that goes out. Also got some interesting info about the economy in general from econ70.com. Before COVID-19, the cost to ship a 40-foot container from Shanghai to LA was generally be about $2,000. Soon after COVID-19 appeared, it doubled to $4,000, where it stayed through the first 4 months of 2021. Then it increased explosively in late 2021. The price peaked at slightly above $12,000, and now it has come down to about $7,000, which is still a lot higher than the $2,000 previous. Looking into next week, we have not nearly as much data this week as this week. On Tuesday, we do get industrial production, which is a sign of inflation. We're going to get business inventories, another measure of inflation, as well as crude oil inventory. As you've heard this week, a lot of stuff has to do surrounding energy costs. Then we get jobless claims, Philly Fed Index, and a 30-year tips auction on Friday to close out the week. I hope you all have a great weekend and check out some of our common sources and influence that we tap into all week to bring you this commentary. Have a great weekend.